Hello and welcome to AgriFocus, the podcast from Agriland that looks in depth at some of the topical issues of the day. I'm Stella Meehan, and today I'm joined by Head of Economics and Surveys at Teagasc, Trevor Donnellan. This week, a new report from Teagasc indicated that as of the middle of 2026, the outlook for the global economy remains a concern due to the ongoing crisis in the Strait of Hormuz, which has pushed up international oil prices and created increased economic uncertainty. Therefore, the outlook for farm incomes in 2026 is weaker than that recorded in 2025, with lower output prices in the dairy and cattle sectors combining with rising input costs to reduce margins across most farm systems. Agricultural input markets have also been under renewed upward pressure in 2026. As a result, production costs are forecast to rise across all farm systems in 2026 relative to the already high levels experienced in recent years. Right now, I want to delve into the forecast or predictions for various sectors. Trevor Donnellan, thank you for joining us on AgriFocus. Let's look into the detail of dairy farm incomes first, Trevor. We know milk prices fell sharply towards the end of 2025 and the milk production season that was 2025. And those milk prices have remained at lower levels in the first half of this year. So what is the outlook for milk price as we head into the second half of the year, Trevor?
Hi Stella. The situation in dairy markets at the moment is a tricky one. We towards the end of last year we saw a sharp reduction in dairy commodity prices, and dairy commodity prices have remained at somewhat low levels, I guess, in 2026. And the reason behind that really is the fact that we've had a big growth in global milk production in all the big export regions of the world over the last 12 months or so. And the expectations around that are that this production growth should ease off now on the basis that milk prices are quite depressed relative to costs in lots of parts of the world at the moment. And that dairy commodity prices should begin to start to creep upwards slowly as we get into the latter stages of this year. But of course, the tricky point from an Irish perspective is the fact that we have such seasonal milk production, which means that the benefits of a rising milk price towards the end of the year won't do very much for farm incomes in 2026. So you'd be more hopeful that with prices starting to move upwards, that might be more beneficial for what might happen in 2027, let's say, in terms of milk price.
Yeah, that's true. As you said there, it won't probably do much for 2026 dairy incomes. And in Ireland, what are the dairy incomes looking like then for 2026 as the predictions stand at the moment? Are we looking at a significant drop?
Yeah, we are looking at a very substantial reduction, and I suppose it shouldn't surprise people too much. Dairy incomes have become so volatile in Ireland, particularly over the last decade. So if you look back over all of the last 6 years, really, the annual percentage change in milk or dairy farm income has been very sizable each year. So you've had, for example, years where incomes have been on a steady increase. And then you've had years where suddenly you get a very sharp reverse or a downward movement in dairy farm income. And 2026 is an example of that. We had really high incomes of an average income of in excess of 150,000 in 2025. And it looks pretty much that average income figure will halve to less than 80,000 in 2026. And it's mainly a milk price story, but as you said in your introduction, costs have been moving upwards as well. So that's another factor that's in here too.
And Trevor, is there any optimism, any positivity on the horizon for the dairymen and women in the short term? Probably not maybe in the short term, I guess.
Not in the very short term. I mean, you what we've seen, if you look back over the last 6 years, for example, what we've seen is that when you end up in a situation where milk prices become quite depressed, it does take a period of time, it does take a year or 18 months for the market to get back into a more balanced situation to allow milk prices to improve. The pattern in recent years is that price improvements happen over an extended period of time, let's say, whereas the price reductions tend to be more rapid, basically, once it becomes obvious that the market is kind of oversupplied with milk.
So then let's look at cattle farms, Trevor. We know cattle price was exceptional last year, but weanling prices are forecast to be down about 10% in 2026 compared to 2025. And then finished cattle prices are expected to average 8% lower than last year, according to this analysis by Teagasc. What are the reasons behind this?
Yeah, I mean, and again, we need to emphasize that price levels for cattle went to an extraordinary level back in last year in 2025, and caught a lot of people by surprise. That the strength of prices was and the increase was quite dramatic. The story this year is a little bit different. We're still in a situation where the market is fairly tight, but not as tight as it was in 2025. And one of the things that we've seen is that the overall production of cattle in Europe continues to kind of move downwards. But the difference this time around, I guess, is that there's been increased exports of beef into the UK market, which is a particularly important market for Irish beef exports, and that has had a depressing effect on UK prices and in other key markets in Europe for beef as well, such as France and Germany. Prices have moved down a bit as well. There's some talk as well that some of the decrease relates to the fact that consumers are starting to become a bit more resistant to the increase in prices that they're having to pay in supermarkets, and that's having a little bit of an effect on the demand side as well. But that's taken a long time to happen. I mean, people have generally put up with dramatically increased prices for beef, and maybe what's happening as well is that people are maybe choosing cheaper cuts of beef over the more expensive steak cuts, to a greater extent. So people are maybe switching away from the luxury of a steak to more commonly having something like a burger or something like that.
Absolutely. And we had already seen that sort of pattern from last year, the move away from steak, and a lot of hospitality outlets, I suppose, restaurants and high-end restaurants were saying that they were actually taking steak off the menu. But now let's move to sheep enterprises, Trevor, and sheep prices are forecast to be around 3% higher in 2026 compared to last year. So a slight bucking of the trend that we've mentioned so far. But let's bear in mind that a lot of sheep farms in Ireland are not solely sheep farms. And this has an impact because they're mixed enterprises. So can you explain that to our listeners, Trevor?
Yeah, I mean, the approach we take when we're looking at farms in Ireland follows the guidance that we have at the EU level. So we have to categorize our farms into Ireland into different farm types. And that would be really easy to do if every farm only produced one single output. But that's not the reality. Very often in Ireland, we have farms that are mainly sheep farms, but might also have some cattle. You have cattle farms that might also have some sheep, and you might have even tillage farms that also happen to have some cattle on the farm. So quite a lot of farms in Ireland would operate on the basis of having more than one kind of significant output. And the way we categorize our farms is on the basis of what's the main thing that they're at, basically from an output value point of view. What's the highest single thing that they're actually selling in value, and that then determines what type of a farm it is. So as you said, quite a few of our sheep farms in Ireland also have what we call a secondary cattle enterprise. And what's happening in 2026 for sheep farming comes as a result is that even though the sheep side of the farm business is probably holding its own compared to 2025 because the prices are slightly higher, cost of production are slightly higher, so margins probably not changing a whole lot in terms of the sheep side of the business. But the cattle side of the business, which would have done quite well in 2025, is not doing quite as well then in 2026 because of the reduction in cattle prices we spoke about earlier. And then that is tending to bring down a little bit the overall average sheep farm income as a result. But if you're a sheep farmer who doesn't have any cattle, you're probably seeing that 2026 is probably a similar enough year to 2025 from an income point of view.
Now, another sector is tillage. And if we look at crops, Teagasc is forecasting that grain prices at harvest in 2026 are expected to be broadly similar to those of last year. But what about the yields, Trevor?
Yeah, I mean, we had a big improvement in crop yields in 2025. The weather conditions in 2025 were very favourable, and that kind of offset what was a very disappointing year in terms of cereal prices last year. There was a big global harvest again last year, and that had a depressing effect on international cereal prices, which has a knock-on effect then for the cereal prices that are paid in Ireland. Like this year, the expectation is that at the moment, and we're still not really at the harvest point, but that price levels will be broadly similar to last year. But the expectation now is that yields this year will be lower than they were in 2025. The weather conditions haven't played ball to the same extent this year. And essentially what you have happening is that the crop is starting to mature faster than you might expect because of all the sunny conditions that we've had. And that ultimately then is expected to lead to a lower yield than what we would have had in 2025. And as I mentioned earlier as well, some of our tillage farms also happen to have a secondary cattle enterprise. And as we talked about, that's not going to do as well in 2026. So overall, the expectation is that tillage farm incomes in 2026 are going to be down quite a bit, perhaps about 20% or thereabouts.
Yeah, significant change from last year's income there, certainly with the crops enterprise. But another enterprise that is set to have a bit of a tricky year this year in 2026 is pig enterprises. Now, obviously, many people would know that traditionally overall pig enterprises would be considered profit-making endeavours for the most part. But African swine fever elsewhere, now not in Ireland, but elsewhere, seems to be playing a part here in the problem for Irish pork this year, Trevor.
Yeah, there's been an African swine fever outbreak in Spain, and as a result of that has limited Spain's pig export opportunities. So what that means onto the global market. So what that means is that we have a larger share of Spain's pig production basically ending up for sale in the EU itself. So that means there's more pig meat available in Europe, and that's having a depressing overall impact on pig meat prices. The pig sector is a curious sector because there's, if everything goes well everywhere in the world for pig production, that tends to mean prices are lower. So what farmers are always strangely watching out for is some kind of a disease outbreak in some other part of the world that will negatively affect production somewhere else in the world, and that has a beneficial effect then in countries elsewhere. So it's a curious sector from that point of view, because the best years for pigs really is when there's a problem somewhere else in the pig production sector globally. Now it happens in this case, of course, that the problem we're talking about is much closer to home, and as a result of that, as I said, European pig prices have become quite depressed. And then on the flip side of it, you've got increased costs in pig production, not so much on the feed side, but on the energy side. And energy is an important input into pig production, given that it's an indoor system. So The costs around electricity and ventilation, heating, cooling, and all that kind of stuff, they're on the up, obviously, because of everything that's happening in the Strait of Hormuz. So as a result of that, it's not looking like a good year for pig production in Europe and in Ireland just as well.
Okay, Trevor, overall, let's talk about viable incomes in farming. Overall, for the reasons that we outlined at the start, and we've mentioned throughout in terms of geopolitical tensions and conflict that's ongoing at the moment, it doesn't really look like a positive year for making a substantial living in agriculture in Ireland this year.
Yeah, I mean, last year, if you look back to 2025, one of the things we highlighted when we produced the results of the National Farm Survey a few weeks ago is that farm viability had improved quite considerably, especially because of the fact that incomes had increased on cattle farms in Ireland. And the largest single group of farms in Ireland in terms of farm type are our cattle farms. So the fact that so many cattle farms in Ireland had improved incomes last year meant that the overall story around viability had improved. But what we're seeing here now happening in 2026, as we've talked about, is that incomes are down very substantially on dairy farms. Incomes are down significantly enough as well on cattle farms and on tillage farms as well, and to a lesser extent on sheep farms. All the numbers in 2025 moved in the right direction from the perspective of income. And you could say that all the numbers are moving in the wrong direction in 2026 from the perspective of income. So the overall proportion of farms in Ireland that will meet the definition of being viable in 2026 will be lower. And it's probably still be better than what we've seen in earlier years. 2025 was exceptional because more than half of the farms in Ireland met the definition of viability, and very often that figure would be down at closer to 40%, and maybe sometimes even less than that. So, yeah, I mean, it's definitely a trickier year in 2026 from the perspective of income across the various farm systems.
Yeah, that's for sure. It's a hard industry to work in. I mean, I have my job, and if I were doing the same amount of work in the same way this year as I was last year, and I was seeing my income just drop by more than 20% through no actions of my own, sometimes it's a hard pill to swallow, but as an island that exports 90% of what we produce, we're always going to be a slave to those global markets and global activity, Trevor, isn't that it?
Yeah, I mean, one of the things we've been highlighting of late in respect of the whole farm income story in Ireland is how volatile incomes are from one year to the next. And this used to be something that was kind of largely confined to dairy farms and tillage farms. They had quite volatile incomes, but increasingly in recent years now we're seeing that volatility showing up as well in the cattle system and in sheep also. And it's a serious concern, not just in Ireland, but at an overall European level, even at a global level. As you said, somebody who isn't working in agriculture would expect that as long as they were doing a day's work or a week's work or a year's work, that they'd have a good understanding of how much money that was going to come in the door. And increasingly in agriculture, that's not the case. And the concern is that it could be a deterrent in terms of younger generations taking the interest to take over farms. Like when we talk about high average incomes in dairy farms in certain years, for example, the 153,000 figure we had for 2025, that looks quite attractive. But that needs to be put in the context of 2023, where incomes were only about 50,000. So that huge volatility in income from one year to the next, even in a sector that most of us consider to be doing very well overall and being top dog, let's say, in terms of Irish agriculture, those are huge swings in income. And then when you look at some of the sectors which generally have lower levels of income, like the cattle systems, for example. If we go back there even a few years, just to 2023, that the cattle rearing, the suckler sector, that had an average farm income of only €7,000, which is, extraordinarily low. Much lower even than the support payments that would be going to an average farm like that. So that tells you that that farm was operating, those farms were operating at a significant economic loss in a year like that. So this volatility in income is a huge issue. What it highlights as well is how important the support payments are, because the support payments aren't volatile. The support payments are generally a predictable amount each year, so farmers know at least that part of their income is secure. But the margins they're achieving, those are moving over, large ranges, and that's having an overall impact then in the income levels that are being achieved from one year to the next. And as I said, it's something that people looking at agriculture and a career in agriculture would be concerned about.
Yeah, certainly a challenge there for the next generation of farming in this country. As you said, they're trying to get the younger generation in while making it appear that there is a viable income and a viable future for them. Well, that's all we have time for on this episode of AgriFocus. Thanks to my guest, Head of Economics and Surveys at Teagasc, Trevor Donnellan, for joining us today. If you found this episode interesting, please rate and review it by giving it 5 stars on any of the podcast platforms. And do indeed share it with someone who you think might like to listen in. But until next time, goodbye and take care.